Before this video ends, I'll show you the hidden signal in COMX May 2026 silver delivery positioning, plus any further registered inventory decline, and why the obvious interpretation is wrong. COMX May 2026 silver delivery positioning, plus any further registered inventory decline, looks straightforward, but the real story is disbelief, and most viewers are missing the move. The latest numbers, timing, and catalyst chain point to something that does not line up with the lazy headline version. The obvious headline and the real implication are different. And as of April 11, 2026, the April 6th Dubai/COMEX video is still the fastest silver gold breakout at 63.8, and the next COMEX May silver delivery window gives the premium a fresh scarcity clock. Clarify what changes next, why it matters now, and how a real holder or stacker should think about the move. The key question is what changes first, and that answer is not where most people are looking. Physical stacker ounce level implications tied to east versus west pressure and real acquisition cost. Start with the east versus west divide, because that is where most people lose the plot. In the east, silver gets treated like inventory, savings, and strategic stock all at once. Buyers care about bars in hand, shipping availability, and the actual premium over spot they must pay today. In the west, silver is still mostly introduced through futures, ETFs, leverage, and paper exposure. That does not mean the west is fake and the east is pure. It means the west can stay comfortable with a quoted price longer because contracts absorb stress before shelves do. Dubai matters because it sits close to the physical trade routes where immediate demand shows up fast. When Dubai pays far above paper spot, it is not making a philosophical point. It is telling you the real acquisition cost of silver in that region is already higher than the headline price most Western viewers see on screen. That $18 premium is the first alarm bell. If spot says one thing, but a real buyer in Dubai must pay $18 more per ounce to secure metal, then silver already has two prices, the reference price and the get it now price. That is exactly the kind of split that paper markets can ignore for a while and then reprice very quickly. A lot of people hear a premium and think it is just dealer markup noise. Not at this size. A premium this large into a delivery setup is the market's way of saying immediacy has value, convenience has value, certainty has value, and when certainty starts costing that much more, the easy price is usually the paper price, not the physical one. What this means for you is simple. If your bag is 18 ounces, an $18 premium is already a $324 difference between spot logic and real-world cost. On 50 ounces, it is $900. On 100 ounces, it is $1,800. Even if spot stands still, your replacement cost may not. Now layer on the COMEX side. The phrase 78% drain sounds dramatic, but most people still do not know why it matters. COMEX inventories are not all equally available. Eligible silver is metal inside the system that meets specs, but it is not automatically committed to delivery. Registered silver is the portion actually tagged and ready to satisfy futures delivery. That distinction is everything. If registered inventory falls sharply, the exchange can still look stocked on paper because total ounces in vaults exist somewhere in the warehouse complex, but the pile that can immediately settle delivery obligations is smaller. That is why a drain in registered silver matters more than a casual inventory headline. It narrows the buffer. It reduces optionality. It forces more attention onto the ounces that are truly deliverable, not merely present. What this means for you is simple. An 18-ounce stacker does not need a global shortage to feel pressure. You only need the available deliverable pool to get tight enough that replacement metal starts costing more than the chart suggests. This is why May 2026 is the catalyst. Delivery months expose whether paper longs really want cash exposure or whether enough of them want actual metal. Most contracts roll. Everyone knows that. The mistake is assuming only a tiny percentage needs to stand for delivery before nothing matters. In a tight setup, The marginal ounce is what moves the market. If registered silver is already thinner and a premium is already elevated in Dubai, then May does not need a cinematic failure to matter. It just needs more buyers than usual, deciding they prefer bars over rollover. That is how a calm paper price suddenly starts looking late. The exchange may continue functioning. The chart may still look orderly, but the cost of getting silver in the real world can keep separating from the quote. What this means for you is simple. On 100 ounces, even a partial catch-up of that physical gap changes your entry or replacement price fast. On a 500-ounce position, every extra dollar is another $500 decision. And if this breakdown is helping you separate headline spot from real acquisition cost, hit like right here, because this is where the story gets more important. The second proof point is not just the premium or the inventory drain by itself, it is the direction of pull. Physical metal has a habit of moving toward the highest real bid, and right now, that pull is stronger in the east than in the west. Dubai is not an isolated curiosity. It is part of a broader pattern where physical hubs react faster to scarcity than paper hubs do. The east accumulates what it can weigh, ship, and vault. The west keeps pricing what it can hedge, finance, and roll. That difference is why spot can look sleepy while the underlying physical market is already tightening. Bars do not care about narratives. They move toward the place willing to pay. Once they move, they are not always quick to come back. What this means for you is simple. If you wait for Western spot to fully confirm what Eastern premiums are already saying, your first extra 18 ounces may cost meaningfully more than the ones you hesitated on today. This is also where the idea of paper suppression or paper lag becomes useful. You do not even need a dramatic manipulation story to understand the mechanism. Western pricing is built to absorb stress through derivatives first. Market makers hedge, funds roll, shorts and longs offset, inventories get reclassified, the system buys time. That time is valuable when supply is merely tight. It becomes dangerous when physical demand keeps pulling metal away faster than price responds. So whether you call it suppression, lag, or delay, the effect is the same for a real stacker. The screen can stay calm longer than the physical market deserves. That is why East versus West matters so much here. The East is telling you what it costs to own silver now. The West is still telling you what it costs to reference silver on paper. What this means for you is simple. A 100-ounce buyer who waits for perfect confirmation may be gambling on a delayed quote, not on a cheaper physical market. Here is the credibility peak in this story. I am not telling you silver is disappearing, and I am not telling you every volt ounce is fake. I am telling you the market is split between accessible paper price and increasingly contested physical price, and the split is showing up right before a delivery window that can expose stress quickly. That is a real setup, not a fantasy setup. If you want this tracked all the way through the May delivery window and any further registered decline, subscribe now because the signal will be in the daily plumbing, not in the loudest headlines. Watch what happens if registered ounces fall again while Dubai keeps demanding a large premium. That is the kind of combination that forces even skeptical traders to pay attention. And if the premium cools while inventories stabilize, that is useful too, because it tells you the tension is easing instead of compounding. Now bring this down to the level that actually matters. Your ounces. If you are holding an 18-ounce starter stack, the mistake is thinking this story only matters to institutions and 1,000-ounce bars. It matters to you because your next 18 ounces are bought in the same market structure. An $18 difference is $324. That is not theoretical. If you are building toward 100 ounces, that same gap is $1,800. If you already own a monster box, that is 500 ounces and a $9,000 difference between paper complacency and physical reality. And if you are somewhere in between, the point does not change. Your bag size tells you how sensitive your future buying power is to a seemingly small per ounce move. Comment with your real bag size, whether it is 18 ounces, 50, 100, or 500, because this is where silver stops being abstract macro talk and becomes a personal cost basis problem. This is also why quantified scenario framing matters more than generic silver hype. Imagine spot does not explode higher. Imagine it only begins to close part of the physical gap. If half of an $18 premium bleeds back into Western pricing, that is still roughly $9 per ounce. On 18 ounces, that is $162. On 100 ounces, it is $900. On 500 ounces, it is $4,500. Now imagine the full gap starts getting respected because May delivery tightens the visible buffer and Eastern bidding stays firm. That is the full $324, $1,800 or $9,000 math we just walked through. None of that requires moonshot fantasy. It only requires the paper market to admit what the physical market is already charging. That is why this setup is dangerous for anyone treating spot as the whole truth. Spot may be the first number you see, but replacement cost is the number that hits you. There are, of course, two ways this cools down. First, the Dubai premium can fade meaningfully, which would tell you physical urgency is easing. Second, COMEX registered inventory can stabilize or rebuild into May, which would tell you the delivery buffer is less stressed than it looked. If both happen together, then this episode becomes an important warning rather than a decisive repricing event. But if only one side relaxes while the other stays tight, the imbalance remains. A softer premium with falling registered stocks still leaves the West exposed to another squeeze in physical availability. Stable inventories with a stubbornly high premium still tell you real buyers are paying up for immediacy. So do not reduce this to one number or one chart. Watch the relationship. Watch whether the East keeps accumulating physical metal while the West keeps defending a calmer paper narrative. That relationship is the tell. Over the next several weeks into May, I would focus on four simple things. Watch whether registered silver keeps declining. Watch whether delivery interest stays sticky instead of rolling away. Watch whether Dubai and other Eastern physical hubs keep holding a visible premium over Western spot. And watch whether Western commentary keeps calling it temporary noise, while real buyers keep paying up anyway. If those four line up in the wrong direction, silver does not need a dramatic failure headline to reprice. It just needs more people realizing that the cheap reference price is not the same as the actual acquisition price. What this means for you is simple. If you are dollar cost averaging into 18 ounces at a time, your timing window can close faster than the chart suggests. If you are waiting to add a 100-ounce bar, a few quiet weeks can still become an expensive wait. Now let me resolve the open loop from the beginning. The most important number in this story is not the $18 premium and not even the 78% drain by itself. It is the amount of silver that is both inside the system and actually available to satisfy delivery relative to how many claims want that delivery. In plain English, it is the registered ounces per standing demand. That is the pressure gauge. When that ratio falls, Western spot loses authority because too many people are referencing silver and too few ounces are freely deliverable at that reference price. That is why May matters. That is why Dubai matters. And that is why East versus West is the right frame. The East is discovering price through physical accumulation. The West is discovering price through paper convenience, and paper convenience works until the physical math gets too tight. So the hidden truth in this setup is not that silver has already exploded. It is that the market is showing you two different realities at the same time. Reality one is the paper quote, still calm enough to keep most people passive. Reality two is the physical signal, already urgent enough to make Dubai pay a steep premium while COMEX heads into a critical delivery period with less registered cushion. When those two realities collide, the adjustment usually happens in the paper price, not in the physical buyer suddenly becoming patient. That is the asymmetry. The East has been accumulating metal. The West has been pricing claims. If the claim price is wrong, it does not stay wrong forever. It stays wrong until timing runs out. That is the setup into May 2026. If registered silver weakens further and Eastern premiums stay elevated, the West is likely the side that has to move. If inventories stabilize and premiums cool, the signal softens and we reassess. Either way, the smart move is to stop treating spot as the only truth. Watch the physical premium, Watch the deliverable pull. Watch what your own bag size means in dollar terms before the next delivery window forces the issue. That is how you stay ahead of a silver market that looks calm on paper and tight in the real world,